All right. Welcome to the favorite part of your learning, practice. So this is the conclusion of private special situations in private markets. And we're going to go through a couple of questions. My advice is always that you pause the video, read through the question, attempt the question by yourself, and then come back and see how I do it. Okay, let's get right into this. Question number 1. Which of the following best describes what Jenkins is seeking to illustrate with her visuals in the put-call parity equation? So what Jenkins has done is that as part of her work, she develops two visuals showing the contingent payoffs on both debt and equity holders as a function of the asset value of a company, and an equation demonstrating put-call parity. You remember, put-call parity is just the value of the asset, the stock price, and the put option, which is equal to the call option plus the present value of a risk-free debt. This is the put-call parity. So what does this demonstrate? If you go through the solutions here, you're going to see that option C would be the debt and equity values may be characterized as option values based on company asset value. Your company asset value, V, this one, is given by this option and the present value of the debt minus the put option. So the company asset value V is this call option, which is the equity, and this present value of the debt with a put option on it, this is the debt. So we have characterized the value of the company as option values, call option, put option. Option C is the correct answer. Number 2, analyze whether there is a profitable capital structure arbitrage trade available based on Jenkins' example. So Jenkins has given this example here, and if you read through this, we are going to use this information. I'll highlight information as I use it. But what's important is that the company's debt is trading at an observed credit spread. So if you have the observed spread of debt, you want to compare this to the implied. So this is for the debt. You want to compare this with the implied spread for equity. How do we get the implied spread for equity? We calculate this for structural models using the Merton model, and the implied spread is given by 1 over the time horizon multiplied by the natural logarithm of the face value of the debt over the current price of debt minus the risk-free rate, and this is equal to, all right. And then when you read through this, we are talking about a structural model. We have the company's asset value is 800, 0 coupon, 1 million, maturing in 2 years. So the time horizon is 2, 1 over 2. Then the face value of the debt is given here. The debt face value is 1 billion, so it's 1,000 million. Then we divide by, we are going to divide by the current value of the debt. The current value of the debt, we have the asset value. Remember, if you look at this equation I wrote here, we said the value of the company is just the equity plus the debt, right? Which means the debt is just the value of the company minus the value of equity. That's what we are going to write here. The value of the company is given here is 800, and the value of equity is given, the value of equity is given as 52 million here. So we subtract 52 million here. Then the answer we get here, we subtract the risk-free rate, and our risk-free rate is given as 5%. Subtract 0.05. If we calculate this, we're going to get 9.5%. So what we see here is that the implied equity spread is 9.5. The given bond spread is 4. So this is greater. We expect this to go down because this must align. We expect this to go down, making the bonds more valuable in the future. If we are supposed to take a long position on the bond we buy. And then we sell equity. We buy the bond and then we sell the equity. That's the strategy we use based on this. I hope you managed to do that. Let's go to the next one. Okay. Read through and then attempt first before we do it together. We want to discuss the potential for a distressed issuer to suffer from excessive loss of employees, depending on whether distress is more related to industry-specific conditions than company mismanagement. So what we know is that the operational risk is the one that results in the loss of employees. So the operational risk will result in loss of employees, and this is going to depend on events leading to the distress, which can either be macroeconomic events, or these events could be industry specific, or the events could be company specific. So macroeconomic events could be based on the business cycle. If the economy goes through a downturn, that's when the economy is going through a recession. Most industries might actually be struggling, and this might lead to poor operating performance and financial performance for any firm. Industry specific ones, these are specific to a particular industry. Like you remember during COVID-19, traveling was restricted. So the travel industry had to let go a lot of people. If your experience is specific to this industry, then you're going to struggle, obviously. Company specific, e.g. mismanagement, people will just move from one company to another, which is being properly managed. So these are the different issues that you might face because of distressed issuer. The number 4, discuss one fundamental difference with respect to a distressed debt allocation between committing capital to Bywater versus Splinwood. So you want to have a comparison between Bywater and Splinwood. If Northern States commits their money to Bywater, they are making an explicit allocation to distressed debt. So this is an explicit allocation. Okay. And in contrast, if they commit their money, so this is a commitment to Bywater, right? It's an explicit allocation. But if they commit their money to Splinwood, this allocation is only going to happen in a dislocation event. Okay, Splinwood has begun including contingent dislocation funds. So this allocation to Splinwood is going to be allocated contingent on a dislocation event. Remember, dislocation is going to happen if there is an event such as a global financial crisis. So this is market-wide. This is for the entire market. This is market-wide. If there is this event that affects, or maybe there's a political event, you are going to have a dislocation event where there's mispricing in the market. So spleenhood, the allocation is going to be contingent on that. All right, I hope this is clear. Let's go to the next one. Read through this information and then we go through it together again. So first attempt, then we do it together. The first one, we want to contrast the event risk associated with major arbitrage and with the event risk typically associated with distressed debt investing. With major arbitrage, remember, the strategy is going to generate returns if this is contingent on whether or not the acquisition is completed. Okay, so this is going to be defined on whether or not there's a completion of the transaction of acquisition. And this is where the returns are going to come from. They are dependent on this. But for distressed debt investing, this is a bit more complicated, because this is not just whether or not the transaction has been completed. It's going to take into account a lot of things. For example, there have been a bankruptcy proceeding. Did the claimants get anything? What are the claims? Is the company being reorganized? Is the company being reorganized through chapters 9, 11, and 15, or is the company being liquidated through chapter 7? So the event risk for distressed debt is more complicated compared to the major arbitrage, which just considers whether or not the acquisition has been completed on the announced date. Number 6, discuss how Spleenwood expects to profit from a strategy targeting companies with change of control clause. So the change of control clause, it's actually a clause in a contract that says that should there be a change of control or a change of ownership in a company, the debt has to be resold at better terms. So basically, with a change of control, the issuer has to offer a repurchase of the outstanding bonds at a fixed price or a price above par. It's either fixed or the price has to be greater than par. When there is a new ownership, the company has been acquired by someone else, or someone else has more voting rights in the company. So what Spleenwood is going to do is identify companies that have a change of control clause, and the likelihood of this happening is quite high. When they purchase these bonds and there is now a takeover of the company, when a takeover happens of the company, the shares are going to be reissued at par or greater than par, actually, at par or greater than par. By buying the debt of the most likely takeover target, what Spleenwood expects is to sell back the purchase bonds at a profit once the change of control clause has been triggered. So they have to sell back at a higher price once the change of control clause has been triggered. Number 7, discuss why Spleenwood may prefer to negotiate debt for equity exchange as a financing strategy compared to other possible strategies for its portfolio holdings in which mismanagement perceptions exist, and explain a potential challenge to implement this strategy. Okay, so the debt for equity you exchange your debt with your equity. If they get equity, they get some form of control of the company. Okay, if they get some control of the company, then they can reorganize this management. If there's mismanagement, what you want to do is to take control of the company. And if you get sufficient equity in a company, you have some form of control and you can reorganize. Other forms of refinancing are not going to give this kind of control. It's only when you have sufficient equity that you can get this kind of control. because you have ownership, this is going to translate into ownership. However, the challenge is that are they going to be able to buy sufficient equity, or are they going to have sufficient ownership of the company for them to ensure that they have governance power? Because they might buy equity but not have enough to control and change the management and put in place this management they believe will be able to take the company forward. That's the challenge. But the main reason they would opt for this is so that they can gain control of the company. Okay, and then number 8, discuss one significant reason why Spleenwood prefers to avoid unplanned Chapter 11 bankruptcy filings for companies in which it has invested in debt, and discuss briefly what must happen to avoid this outcome. Chapter 11 does not result in liquidation, right? But the problem is that it takes time. Anything that goes to courts takes time, because the courts have a lot of cases that they are dealing with. So it takes time, and this issue might not be resolved timelessly. The typical time frame for a company to be successfully reorganized, it's anything from 2 to 3 years. Anything from 2 to 3 years or more. It can actually exceed these 3 years. And this would reflect Spleenwood's investment horizon as an active controlling investor. So there will still be an active controlling investor whilst the company is being restructured or being reorganized. So to avoid the unplanned Chapter 11 bankruptcy, this would require now an agreement between Spleenwood and the creditors. Okay, for them to get in a pre-packaged bankruptcy agreement, remember you can get into a pre-packaged bankruptcy agreement. This is going to require 2/3 of the volume and 1/2 of the claimants to agree in terms. So you have 2/3 and 1/2 of the claimants. You need 1/2 of the claimants to agree, such that you can get into a pre-packaged agreement, bankruptcy agreement. Whilst an out-of-court restructuring is going to require all creditors. So if it's going to be an out-of-court agreement, it will require all creditors to agree. All creditors should agree if this has to be done out of court. Okay, let's move to the next one. So read through this and then we will do it together. Recommend whether Labo should pursue an investment in Fracassa debt. Should they? Let's see here. The enterprise value is 9 billion. It estimates the probability of 30% that there's going to be a default on 7.5 billion of debt in 6 months. All right, the liquidation value is 3 billion. Assume a risk-free rate of 5%. So the enterprise value in 6 months, would then be equal to, you see, in 6 months there's a 30% probability that there's default. So 30% of default, and what amount do they get when they default? The assesses the liquidation value of Fracas assets to be 3 billion, 3,000 million. This is the liquidation value, so this means there's a default. But if there's no default, the probability would be 1 minus this, 0.7. And if there's no default, the value in 6 months, it's currently trading at 6 billion, but valued as a going concern and comparables at an enterprise value of 9 billion in 6 months. So if there is no liquidation in 6 months, you multiply this by 9 billion. Calculate this, we're going to get 7.2 billion pounds. Okay. So recommend whether Labrador should pursue an investment in the Fracas debt. If they buy all of the debt for Fracas, if Labo buys all Fracas debt, the expected value in 6 months is going to be this amount. So the expected value if they buy all the debt, it's 0.3 multiplied by 3,000 plus in 6 months the Fracas debt is going to default to 7,500. So we're going to multiply 0.7 times 7,500. Then if we calculate this, we're going to have 6,150. All right. So what is the return that we are seeing here? What is the return that we get in this instance? The enterprise value that we expect in 6 months is 7,200, and if they invest in Fracas debt, they are going to get 6,150 million. We are told that the maturing in 6 months is currently trading. It currently trades at 6,000 million, and in 6 months it will be 6,150. So what is the return here? 6,150 in 6 months. This is the value in 6 months divided by the current value of the debt. And then minus 1, it will give you 2.5%. This gives you 2.5%. So should we invest in this if in 6 months we get 2.5? Remember, the annual return, the annual risk-free rate is 5%. Half of this is 2.5, which means you are going to get a return which is equal to the risk-free rate. And this doesn't take into account the probability of default because this debt is distressed. There must be a premium on top of this. They must add a premium for taking on risk on distressed debt. So it's a no. Do not invest. Because you get a return equal to the risk-free rate without any premium given there. Hence, you do not invest there. It's not a good idea. Question 10. Evaluate the choice of estimating Fracas going concern value using relative valuation versus income-based. So we are making a comparison between relative valuation and income-based approaches. Both of these approaches are going to be difficult to use for distressed companies. Remember, they both of them, they have their own challenges, right? We have the relative valuation, which is comparables. That's the relative valuation. And we have the income-based approaches. Remember, with this approach, you use discounted cash flows, right? The intrinsic value of a company would just be the sum of the free cash flow to the firm of from I equals to 1 to n over the weighted average cost of capital to the power of I plus the terminal value over the weighted average cost of capital to the power of n. So you look at the numerator where we say the timing and magnitude of the cash flows are difficult to anticipate. And then the terminal values, this is tricky if the company is not a going concern. And the weighted average cost of capital is likely to be understated because we use the yield to maturity, which basically is the expected return, which is the desired return and not the expected return, which takes into account the expected loss. So that's the challenges that come with this income-based approach. Okay, and then in terms of the relative valuation approaches, right? The peers may not be going through distress, so they may be non-distressed, and it poses challenges because you want to compare companies in distress and companies that are not in distress, and that again will pose challenges, and calculating terminal values based on that is going to come with its own challenges. Okay. Number 11, recommend a capital structure arbitrage trade involving fracas senior and junior debt. I want you to give this a try, and then we are going to do this one together. You see here that there's 4.5 billion of senior secured debt and 3 billion of junior second lien debt. The senior debt is trading as 4.2 and the junior debt is trading as 1.8. Recommend capital structure arbitrage trading involving the junior and the senior debt. Okay, so let's look at the value of the senior debt in 6 months. So let's look at senior debt in 6 months. If there's a default in 6 months, the senior debt is going to recover all of its money. So in the condition of default, probability of default is 0.3. The senior debt is going to be recovered. They can't recover all of it because we are told that in 6 months' time, the assets of the firm, if there's default, is a maximum of 3,000. So all this 3,000 is going to go to the senior debt. And then if there's no default, they get all of their money. Okay, and if you calculate this, you're going to get an answer of 4050. Then for junior debt, remember, if there's a credit event in 6 months, the company assets are 3,000, the senior debt is 4,500. So all of the 3,000 is going to go to the senior debt, which means the junior debt will get nothing. But if there's no event, credit event, 0.7, they get all their money, which is 3,000. So 70% of 3,000 is 2,100. Then we compare. Let's look at the senior debt. The senior debt is trading at 4,200, which is greater than the implied value that we get from our model, which means in the market, this debt, the senior debt, is overpriced. And the junior debt, it's 2,100. That's the price for the junior debt, implied price. But in the market, it's trading at 1,800. So these are our market values, which means the junior debt is underpriced. What you're going to do is that you're going to sell this overpriced. So you sell short the senior debt and then you long the junior debt because it's underpriced. Then you're done. That's how you do that. Very simple, easy as ABC. Explain how Labo can create a synthetic fracas bond using a CDS. So to create a synthetic long bond position using CDS, what the investor is going to do, this is our investor. To create a synthetic bond when you're using the CDS, remember when you use the CDS, we don't actually own the bond, but we deposit the amount of the bond that we want to purchase at a risk-free rate. So this investor is going to deposit at a risk-free rate risk-free rate deposit. And if they make this, if the investor makes this deposit, what it then implies is that the investor should receive the market reference rate. And then the investor is going to enter into a receive fixed swap. So the investor is going to receive this fixed amount, but they have to pay the market reference rate to the counterparty. So if they are receiving fixed, so this is the receive fixed, which means it's a pay floating. So this is done with a swap counterparty, and you see that this is a bond. It's a reflection of a bond in the sense that you're getting these fixed rates, because these rates are going to cancel out. This is, you're receiving this and you're paying this, so they cancel out and you're left with this fixed. And then to manage the risk, you're going to enter into a credit default swap with the counterparty, a CDS counterparty here. And with the CDS counterparty, what you're going to do is you're going to sell CDS protection. So if you sell CDS protection, you will be receiving the CDS premium. You'll be receiving the CDS premium. Should there be a credit event, this investor is going to lose an amount equivalent to the loss given default. But if there's no credit event, what you realize is that the net cash flow for the investor, the net cash flow is going to be equal to, remember, these two cancel out, you're left with this fixed amount plus this CDS premium. This becomes the net cash flow, which is the equivalent of like the coupon rate that they get. So they get over and above the fixed rate they get from the swap counterparty. They also get the premium. They will only lose out if there's a credit event, and they lose out an amount equivalent to the loss given default. All right, I hope you get this, and this marks the end of our private markets special situations. Mr. Mash is out. You guys must enjoy capital markets. I'll see you in the next one, where we are going to be discussing private real estate. Peace.